This is a newer initiative by our company, in the fact that, as Cliff had just mentioned, responsible investing is gaining more and more traction, and people want to know where their money is going, and not only to possibly achieve market returns, but also to make sure that it's going to the good of society as well as the world. So I start here by feeling that this is going to put it into perspective. So in essence, it's becoming hard to ignore the rapid shifts that are taking place currently right now in the corporate landscape around the world. And ways of conducting business are evolving, as are the factors that can help or hinder a company's future performance and success. Now, the World Economic Forum, as I'm sure some of you are familiar with, they put out an annual global risk perception survey where they identify what the top 5 global risks are in our world that are happening in terms of likelihood as well as impact. Yes?
Who are they surveying? Who's giving the feedback?
So essentially, when they put this out 10 years ago, there was only one risk that accounted for environmental, social, and governance issues, and that ended up being cybersecurity. Fast forward to present day, and this was the 2018 survey, and as you can see, every single risk here that we're looking at deals with environmental, social, and governance issues. So given that shift, companies around the world have faced major crises due to the fact of ignoring the risks as well as opportunities dealing with environmental, social, and governance issues. And so they are now starting to take a deeper look at that, and in order to remain resilient against these risks that we're encountering, these type of black swan events that we're dealing with right now, they need to know how to be resilient against these risks while also seizing opportunities, so they know that they need to act fast and they need to act now. So what does that mean to you as an investor? So essentially here, I think it means a few things. Number one, when looking at responsible investments, what it can do for you is that you can act for a better world. So just as Theo had mentioned, when you're putting your money to work, not only are you looking to achieve market returns, but you're also looking to help the world and the good of the world. So you also get a more accurate analysis when it comes to responsible investing. So what it does is it not only combines fundamental analysis and engagement, but it does it through a lens of environmental, social, and governance factors. You can also pursue long-term competitive returns, and I'm going to touch upon that later on in the presentation. That's actually been an argument when it comes to responsible investments, meaning when you look to invest in a responsible investment, you may look at not achieving market returns, and that couldn't be the case. It actually deals with investing in quality companies that are going to be able to weather the storm when we have some of these types of black swan events that we encounter. And then lastly, there's more investment transparency within responsible investments, meaning there are now asset managers like Amundi Pioneer, who I work with, where we're giving more accurate analysis and we're being more transparent in regards to where we're investing our money, the type of companies that we're investing in, and what their ESG philosophy is. And that's important for you as investors, so you know where you're putting your money. So with that said, I'm just going to talk about how responsible investment is becoming mainstream, and I'm going to show you some of the trends that are going on with responsible investment. We'll talk about some of the basics, so Responsible Investing 101, why it's gaining momentum, how asset managers like myself and companies are actually incorporating ESG factors into the investment process, some of the hurdles that we still have to overcome in, for example, developing a common language, because many companies and many asset managers actually view ESG in different ways. So coming up with that common framework so there's a better understanding of how it works. And then lastly, I'll just summarize everything. And just so you know in front of you, this is the deck presentation that we have. So everything that I'm going over here, you've got. And then this is a handout take home that will actually summarize everything that I'm talking about. Just because you're wonderful and taking pictures, and I don't want you to have to do that because you got it all right here. No worries at all. Not at all. So this is actually a presentation that we newly created, or I actually recently created, and I actually am normally giving it to financial advisors. So I tailored it a little bit for us here for this session, but this is a slide that I think is very important, and it's actually recent statistics that were put out by Financial Advisor magazine showing how advisors as well as clients, how they're viewing responsible investments currently. So in 2018, 33% of advisors indicated that they had actually initiated conversations about responsible investing with their clients, which is up 18% from 2017. The number of advisors who feel comfortable with responsible investing went from 72% in 2017 to 83% in 2018. 81% of millennials that do not already invest in responsible investing are either interested or very interested. And I think that's very important to note because, as we all know, baby boomers are actually going to be passing down their wealth to their heirs, and it's actually going to be the largest intergenerational wealth transfer that we've seen in history. So it's very important to know that they are interested in responsible investment, putting their money and putting it to good work. So advisors are starting to take notice of that in order to retain those assets. 34% of investors think responsible investing can either improve their returns while managing risk. And then lastly, 65% of investors would be more likely to stay with a financial advisor who discusses responsible investing with them. So I put this slide together in essence to just explain that this isn't a fad. This isn't going away, especially with what's happening around the world and the types of events that we're dealing with, whether that's droughts, whether that's floods, whether that's fires that's going around here with climate change and extreme heat. I mean, these are issues that we need to deal with, and they are going to impact all facets of life, including our investments. So in talking about assets under management with responsible investments, over the last 2 years, and current assets under management in responsible investments have actually reached $30.7 trillion in the beginning of 2018, and that's within the 5 major markets that are shown here. And it represents a 34% increase in just 2 years. If you take a look at the U.S., those assets have grown from $8.7 trillion in the beginning of 2016 to $12 trillion in 2018, which actually represents a 38% increase in just 2 years. So 1 in every $4 of investable assets here in the U.S. are actually managed in this fashion. So 2018 actually proved to be a very tough year for mutual fund inflows. And it's actually the toughest year that we've seen for inflows since 2008 when the financial crisis occurred. But if you take a look here, responsible investments actually showed record net flows for 2018. In total, it actually achieved $5.5 billion in new net flows. So not only did they show a record year of net flows, but they also showed a record year of performance. Actually, 62% of funds in this asset class actually performed in the top half of their Morningstar peers.
How are people rating what's a sustainable fund?
So this specifically, the numbers that I'm showing you here are Morningstar. So it's what Morningstar will capture as sustainable funds. So I will be honest, it's not going to show the entire investment universe. It only will categorize what Morningstar views as responsible.
And you know, it's interesting because I am a financial advisor.
Sure.
So I've looked and I put together 401k platforms.
Okay.
So I'm super interested in this. 'Cause I work in San Francisco. And trying to find out what's under the chassis of Morningstars. Because that's the only one I know. It's difficult.
I know it is.
And sometimes you'll see, oh, this fund is supposed to be very friendly, and then you look at its ratings, and its ratings terrible.
So I'm going to touch upon that too, because also in regards to ratings, like ratings agencies, it depends on everybody. It's a personal preference, essentially. I feel like with responsible investing. It's up to the investor on what they're going to invest in. It's up to the investor as well in regards to what type of research or methodology they're going to use in order to determine what type of investment they're going to use, whether that be rating agencies, other third-party information. I'll cover that. I'll cover it. You're welcome. So with that said, as of April of 2019, there were over 2,300 signatories from over 60 countries all over the world that actually signed on for the United Nations Principles of Responsible Investment. So the Principles of Responsible Investment is actually an international network organization of many companies from around the world that actually look to decide on investment principles and use it as a framework in order to show how you can invest in responsible assets. So that's a significant increase. I can tell you for Amundi Pioneer, we signed on in 2009 as a signatory because we chose to have a commitment to responsible investment in order to help society as well as the world. So as Theo had mentioned, responsible investments actually used to be shown, and it was very big in the institutional market, but as you can see here, it's growing on the retail space and for individual investors. So a recent study put out by US Trust showed that the majority of millennials, Gen X, and women, they stated that a company's ESG track record is very important in their decision-making process of whether they're going to invest or not, which is a really, really big deal. In fact, 72% of high net worth millennials are actually looking at their current portfolios and making sure that the ESG track record that they have in there is sustainable, okay? And that's versus 34% overall. So as I mentioned, with intergenerational wealth transfer, we're anticipating $30 trillion in assets to be moved from baby boomers to their heirs. So financial advisors are now starting to take notice, and I'm sure you do this all the time, and the fact that when that money does move, you're going to want to retain those assets. And millennials are very, very interested in responsible investment. They are very interested in knowing that their money is being put to good use and it's actually helping the world and society as a whole.
What was the number again?
72% of high net worth millennials versus 34% overall. And the study here, if you wanted to take a look, they have a nice brochure on it. It's PDF online. It's the 2018 US Trust Insights on Wealth and Worth. Bank of America put it out.
So how, I mean, when you have a high worth individual, high net worth individual, that person is interested in investing.
Mhm.
Sometimes they're not.
Sometimes they're not.
So maybe, I'm just thinking, because of the people I know who actually do have money they could invest, and they do not. So I'm wondering if even if we were looking at a percentage of those people, maybe the number of people who are willing to even buy a fund or do something is maybe not that big and kind of declining over time since the 50s or 60s. Am I kind of going somewhere?
Isn't it saying it's going up? You're saying
Well, I'm saying-
as the younger people are attracted to that, our generation
think
and
they're
older.
I don't think they're actually investing.
Oh, they
I-
are.
I-
In 401k
Is that-
plans,
is
they
that-
absolutely are.
They are.
Oh, they're great investors. Millennials are phenomenal investors.
Well, I think also
Much better than older people.
And I think when I did research on the study too, I understand what you're saying. I think about myself, for example, and I think about, so I was born in 1981, so I'm technically a millennial, but I wouldn't say that I'm not on the major millennial scale. I've just met there. But when I started, I wasn't making a ton of money. So I wasn't looking to invest my money. I've grown, I now work for an asset manager, or I have for the last 18 years. So I know what I should be doing now. However, it's more talking about, we do have more millennials and individuals who are making more money now. They are looking to put their money to work. And like you're saying, they're investing their assets in 401k plans. They're also looking at the investment choices within 401k plans and looking to see what type of funds are offered in regards to their goals and values. And I think that's a big thing, and this is why we just created this presentation, because I think a lot of financial advisors right now are trying to understand what are the types of questions that they should be asking millennials or that future generation. And it's more of creating they need to be looking at the financial goal process as it's holistically financial goals is what they should be looking at. It's not just about making whatever market returns, it is about that, but it's also how it affects an individual client's goals and values. So I think all companies are different with what they use. Like, for example, I know the portfolio managers that we have will work with ratings agencies. So they'll take a look at a ratings agency and look at their metrics on how they view a company and whether they want to put that or add that into our portfolios. From there, we also do additional research on that. I'm going to get into it actually, and I'll explain like how those rating agencies work and how those report works. And I feel like I can explain that better in another slide. So with giving some of those trends now, I want to show you exactly some of the basics of responsible investing and where it started. So the modern roots of responsible investing actually date all the way back to the turbulent political climate of the 1960s. That's essentially where it ramped up. So you had a series of movements that happened during that decade that actually forever changed the perception of individuals and how they viewed social responsibility as well as accountability. So movements, as we all know, like the Civil Rights Movement, the Vietnam War, equality for women, it was very important during that decade, and it actually shifted into the 1970s to include additional movements such as disarmament, fair labor, and the environment. So over the years, not only has responsible investment been recognized for its contributions on what it does for society as well as the environment, but it also has been recognized for contributions on how it can actually be a good thing for your investment portfolio, specifically with market returns. There has been debate about that, which I'll touch upon, but how it can be good for your investment returns. So what is responsible investing? As I just keep talking about that over and over again, what exactly is it? I can tell you how we view it at Amundi Pioneer. Responsible investment to us is essentially the umbrella term of a wide array of strategies that can be shown here across this spectrum. They start for values-driven strategies, meaning they are specific to your core beliefs and values, and they range from that all the way to economically driven strategies where not only can they focus on your goals and values, but they also can help you to achieve market returns. So we actually lump that into 4 specific categories: impact-only investments, exclusion and inclusionary screening, which is what we refer to as the original form of socially responsible investment, thematic investing, and integrated investing, which essentially is integrating environmental, social, governance factors into the investment process. So it's important to note that though these categories may not be mutually exclusive, we do feel that viewing these types of strategies across this spectrum may be easier for investors to understand exactly how responsible investments work and which type of strategy would be suitable for their needs. So let me just cover briefly how those 4 categories work. So in regards to impact-only investments are investments that are made specifically with the intention to generate a measurable positive impact on society as well as the environment. And it's actually specific to that investor's intent. So it's important to note that I really, really want to emphasize that it's all about the investor's intent. So when they're looking at an impact-only investment, they're looking at that specific investment specifically because of its positive effects on society as well as the environment. They're looking at that, and they are not looking necessarily at achieving above average market returns. So for impact investors, a great framework that they use are the UN's Sustainable Development Goals, or what we refer to as SDGs. Have you guys seen this before? It's a wonderful framework for impact investors, and essentially the SDGs are a collection of 17 interrelated global goals that the UN has created and they want to ambitiously achieve by the year 2030. So these types of things that they're looking to achieve can go anywhere from poverty to hunger to diversity and inclusion to climate change and clean water, etc. So
Can these be looked up? Like, can you go somewhere and find it?
yes, Absolutely. Just go right to the United Nations website. Yep, you can type in. And then you can actually click on each of these goals and they'll specifically go into each of them. So it's important to note that in order to achieve these goals, it's going to require several trillions of dollars each year in order to target that goal by 2030. So the UN understands that they're not going to get there just through philanthropy as well as government funding, which is why they have actually called upon the private sector to actually step up and be investors within this plan. So impact investors are actually very energized by the Sustainable Development Goals because they use it as a powerful framework in order to align their current investment portfolios, or when they do decide to invest and they specifically look at a goal that they want to achieve, they look at this type of framework and they will mimic their investment portfolio according to this framework. So moving along the spectrum, we move to exclusionary screening. So exclusionary screening, many of you I'm sure have heard of because it's often referred to as the original form of socially responsible investing. Socially responsible investing, exclusionary screening, is essentially the first type of responsible investing. And it essentially, the meaning for exclusionary screening is where investors will exclude any type of company from their investment portfolio that they view as morally unethical to their specific goals and values. So it's actually been used by a lot of churches, endowments, foundations, where, as you can see here from this slide, where they exclude companies that deal with any alcohol, tobacco, gaming, adult filming, etc., pornography. They would exclude those types of companies from their investment portfolio because they don't view it as morally ethical to their goals and values. So there has been a big debate within exclusionary screening over the years that with excluding those types of companies from an investment portfolio, it could actually hinder the performance of that investment portfolio by removing many prominent stocks. And it's also been suggested by research that there's a significant opportunity cost associated with the negative screening. However, that opportunity cost can vary, and it also depends on the type of screening that's used within that method. So this is still a type of strategy that is used quite a bit, but if it doesn't work for the specific investor, they could actually move along to inclusionary screening. So inclusionary screening means just that, and it's the exact opposite of exclusionary screening. So instead of excluding those types of companies, what you're doing is you're including companies that actually do the best of the best, and they do great things for the environment as well as society. So it's often referred to as best-in-class investing. So where exclusionary screening is a little more black and white, inclusionary screening is not. So what it does is that it actually it's a much more rigorous process, and it requires analysis of a lot more complex issues such as pollution, diversity, inclusion, etc. So typical inclusions include solar power companies, natural food manufacturers, environmental cleanup, and recycling. So this actually used to be a tedious type of thing where investors would have to do this type of research on their own, and you no longer have to do that. There's a lot of data research companies that will actually provide that type of research for you. They do all the work for you in order to pick out the best of the best for your investments.
I've got a question.
Yes.
Why wouldn't social responsible investing also include companies that treat their employees well? You know, that make a good effort on.
So diversity and inclusion?
Right.
It does. It would include that.
Okay.
It absolutely
Because
would.
this, to me,
I have another
seems
slide on that.
socially, this, you know, solar and power. I mean, that, you know.
Those are specific. I mean, those are just some examples, but it absolutely would include that.
Okay.
It would. I actually have another slide on that where I'm talking about that. That is it, but it would be something like that that's included. I have 10 minutes? Okay, I'm just going to move along. So in regards to the third category, that is going to be thematic investing. So thematic investing actually aims to identify and profit from long-term structural trends that are shaping our world today. So obviously we know the world in which we live in is constantly changing. It's very dynamic. So thematic investing wants to capitalize on those changes in order to create long-term profit for investors. So how does it work? It's a three-part process. Essentially, first you would identify a specific theme. That theme could be something along the lines of the aging population. It could be advancements in technology, whatever that may be. From there, once you identify the theme, you're going to then look to target companies that can stand to benefit from that theme. And then once you've done that, you're going to construct your portfolio. Lastly, ESG integration. That's where you're going to be integrating environmental, social, and governance factors into the investment process. So in this slide here, from an E perspective, that would be looking to identify companies that deal with climate change, waste and pollution, water conservation, et cetera. From a social perspective, it would deal with diversity and inclusion, human rights, labor relations, cybersecurity. And from a governance perspective, it would deal with proxy voting and shareholder rights, board accountability, business ethics, etc. So what are some of the potential benefits? Seeking competitive returns, and that deals with the quality of companies. So quality companies are going to weather the storm during market downturns because they're going to be prepared versus non-quality companies that won't be able to deal with that. Diversification, it's better to provide diversification by investing in many uncorrelated asset classes versus benchmark hugging. Better risk management, values and beliefs, and innovation.
So the risk management has to deal with some of the environmental issues, like the fires and things like that. So things that could happen.
Correct.
They have less of an impact.
Yep. And then I know I have 10 minutes. I'm going to explain some of that. I'm going to give some examples. So why is it gaining momentum? There's three main reasons. The world is changing, investor expectations are changing, and corporate behavior and responsibility is changing. So let me give you a few examples that break down E, S, and G. So from an E perspective, one of the biggest things that we're dealing with right now, as we all know, is climate change. I mean, we're dealing with it with fires and everything here right now. So the National Climate Assessment actually released a study in late 2018, and they put a direct quote out, and it stated that without significant mitigation efforts, climate change will severely damage the U.S. economy and impact all facets of life, including investment management. So meaning your investments. It exposes the financial stability of an investment to physical risks, liability risks, and transitional risks. So when you think about it, for example, rising sea levels are going to cause flooding, right? So what that does is it disturbs the offshore oil and gas infrastructure, which is going to hurt supply chains, okay? That's one example. Another example is extreme heat with what we're dealing with now. It's not only going to increase energy costs, but essentially it's going to affect labor productivity, anywhere from agriculture to construction. It's going to affect droughts. Droughts actually will hurt the transportation of goods. And so when that affects that, then we're going to have to spend more money on looking at alternative costs to transport those goods. So these types of examples can affect the growth in our markets, and it actually can increase inflation, which is why it's important for the type of funds that you're investing in and the portfolio managers that are looking at companies that the companies that they're looking at have some type of mitigation plan or have some type of philosophy around climate change, because it is going to affect your investments. We're dealing with it right now. Another thing to consider is water conservation. So the UN just put out a study here, a report in 2019, and here's a direct quote. Freshwater reserves account for approximately 2.5% of global water resources, but only 0.6% of total natural freshwater resources are usable by humans, which is scary. So essentially 30% of the global population does not have access to clean water. So an issue like clean water actually is very much ignored by asset managers, and they're not thinking that it could affect investment portfolios, but it can actually negatively impact cash flow, balance sheets, as well as the reputation and corporate value of a company. So a lot of companies right now are actually putting more disclosure around how they're handling situations and scenarios within companies around clean water. More disclosure and transparency. So diversity and inclusion, is part of the S factor, which is what you just brought up. I don't think I'm sure I could bring it up here and everybody's going to know who I'm talking about, but do we remember the issue that happened back in April of 2018 with a coffee company that many of us frequent, where there was an employee who actually called the police on 2 African American individuals because they did not order something from that business in a timely manner, according to that employee. However, they were just waiting in a meeting or waiting for a third party to conduct a meeting. And it actually put them on a diversity and inclusion mission where they closed 8,000 of their stores all across the country and had a whole training on diversity and inclusion. So diversity and inclusion actually is a big deal right now, and it actually does affect investment portfolios. And the reason being is that when you think about it, different perspectives are going to actually create greater change within a company. So having different perspectives and thought processes will actually help a company to deliver better results for customers. Also in regards to the S factor is cybersecurity. An example can be Facebook, as we've just recently learned, who is now being investigated by the Department of Justice, the SEC, as well as the FBI for sharing personal information of their users. They are now in a major class action lawsuit where they are going to lose billions and billions of dollars for doing that. So cybersecurity, as we all know, is a very, very big deal, and it can really ruin the reputation of a company, which is why asset managers like Amundi Pioneer are really taking a good hard look at the companies that we invest in and making sure that they have some type of mitigation plan in case a cybersecurity issue were to come into play. Corporate responsibility in regards to the G factor can deal with board diversity. Shareholders are requiring board diversity to be inclusionary of having more women on their boards, being more diverse. And it's becoming a great deal, a much bigger deal. And the reason being is that, as I mentioned before, different minds think alike. So a company is really taking a good hard look at that and making sure that their boards are diverse in order to handle the challenges that we're facing now in the world today. Lastly, corporate responsibility is changing around shareholder advocacy. So proxy voting and your shareholder rights are becoming more and more important. For 2019, there were nearly 400 shareholder resolutions filed on ESG issues, and of the 400, 303 actually went to vote. So your vote matters, and boards are now taking a look at what shareholders are thinking, and which is why they're taking a better look at diverse boards of directors, better sustainability disclosure, fair pay, and better transparency. So I feel like I don't have a lot of time and we started late, so I want to skip over to these ESG ratings, which we talked about. So I think it's important to note that in regards to investment managers and how they view companies, a lot of them take a look at ESG ratings agencies. So the 4 major rating agencies that are used by most investment managers are right here: MSCI, Sustainalytics, RepRisk, and ISS. And what they do is they will take a look at a company and they will rate it according to their ESG track record. The important thing to note here is that each of these rating agencies, they rate in different manners. Okay, so it's important to note that. I don't think that it's a bad thing for anybody to take a look at those reports, but I will tell you at Amundi Pioneer, what we do is, the first thing we do is we take a look at those reports and we review the information that's given to us, and from there we then do our own research. We don't necessarily rule it out if there's a bad rating necessarily. We'll take a look at it, and then we're further going to do our own due diligence on whether we're going to include that company or not. But I think it's important that you take a look at these because I think it's a great starting point to take a look at what the track record is for that company and then do your own research from there, or have the investment manager do their research from there. I'm just going to summarize and just tell you what the key takeaways are. As we all know, responsible investing continues to grow at a compounding rate. We talked about the trends. It just keeps moving along the spectrum. Again, this isn't a fad. It's not going away. And it's something that investors really need to take a hard look at when they're putting their money to work. The responsible investment landscape has evolved. It's not just about the old original SRI investing and exclusionary screening. There are all different strategies that can be used depending on what your goals and values are. And the biggest barrier to responsible investing is that there's a lack of education. But it's important to note that many companies, including ours, are putting a lot more information out there. There's better transparency, and there's more information for you to make a better decision in regards to how you put your money to work.